Hello everyone. A very good morning to all of you. Hope the morning is good and we can make it better by solving our first mock today. That is for FR. The mock that we are going to solve is going to be practice sum 2 from your direct portal. So let us just join the portal and from there give our mock. Okay. So let's get started. Firstly, guys, for giving a mock, I'll also show you the procedure because it is better off if you give the mock directly from the portal. So there you'll understand that how the CB platform looks like and how you're actually supposed to do your examination, right? It will give you the familiarity to actually do your examination really well because you'll be very much familiar with the type and with the way they ask you the questions, with the whole format of it, right? So I'll just share with you the procedure. Once you open ACCA Global, you go to Students. Okay. So once you open ACCA Global, you go to Students and from there you click Study Support Resources. Once you click on Study Support Resources, that will open up and you can click on ACCA Qualification. In ACCA Qualification, guys, you will choose your subject for which you want to give the mock and we are choosing Financial Reporting. Okay. So once you click on Financial Reporting, guys, there will be a number of things that will open up for you. You have to go down all the way and click Past Exams and Question Practice. You can see here this one. You will click on Past Exams and Question Practice. And once you click on Past Exams and Question Practice, it will show you that what the practice platform content is, like the specimen exam, the practice exams, and the two practice exams are there, right? Below that, it will show you log into the practice platform. You will click on this arrow and you will log into the practice platform. Okay. Now, once you log into the practice platform, you can click on any subject that you want. Right here, we will click on financial reporting. I don't know if it's clearly visible. Yes, it is visible, right? So once you click on financial reporting, two things will open up. That is a blank workspace and ACCA official resources. You will click on ACCA official resources and in ACCA official resources, you have your past exam library. Your past exam library, we are not doing it from the past papers because they are just showing us section C questions in the past papers. So Section A and Section B MCQ questions are not available. So is the reason why we are choosing to do one of the practice exams, that is FR practice exam 2. Okay. You will click on assign. Here it is already assigned is the reason why I unassigned it. So you can click on assign and it will be assigned. So once you click on assign, on the left hand side, you will scroll down and you will see FR past and practice exams. You can see here FR practice exam 2. Now here I think it has already started, so I had just have an option to resume it. Okay. I don't know if I'll get to start it again. Okay. So I just have an option to resume it. Before heading on to this, I think I'll just show you through another paper. Just give me 1 second, guys. Yes, if you click on past exams and question practice, you can go here and I'll choose another paper for showing you how it works. So maybe I'll take audit and assurance, okay, because that is unassigned yet. Now, if you click on audit and assurance, you will see ACC official resources. You can click on practice exams and I'll just assign any one of them. So I'm assigning AA practice exam 1. I've assigned it. You can see here AA past and practice exams and it is assigned to my catalog. Okay. Now once that it is assigned, it asks you for an option to start, which you will click on. Obviously you want to start the test, right? Now guys, before starting the examination, you're going to get these slides. Okay. Before starting the examination, you're going to get these slides wherein they will show you that what are the instructions. Like, you have an option to end exam. The option to end exam will be after the last question. Okay. And you can read through these instructions. You don't need to read through each one of them, right? In the examination, don't waste too much time on utilizing this. Any which ways you get 15 minutes for reading through all of this. We will already know of it because we have read it here already because we'll solve the mocks, correct? So you can click on next. There are more instructions for navigating. You can click on next and previous question if you want to go back to the previous question. If in case any question for you is doubtful or something, or you would want to review that question again, you can flag it. So later on, you can directly jump to the one that you wanted to review. Okay. Then click on next. You can also highlight certain questions. You also have your calculator available here and a scratch pad. So if you're giving your if you're giving your exam home based, then you will be given a scratch pad and you will probably not be allowed a pen and paper, mostly because there are no pen and papers allowed on your table. And you will be given a scratch pad within this CB platform itself where you can actually put any notes for calculation or anything. Okay, and you have a calculator which is inbuilt. If you're giving offline exam, that means actually going to the center, you will be allowed with a pen and paper that they will provide you. So you can either use the scratch pad or you can use their provided pen and paper. Okay. Then you can see here, there is an option to click next. I'll do that. Then there are more things. If you click on the navigator button, it will show you all the questions and you can be navigated easily to the question that you want to jump to. Okay. You can click on next. You can click on close all for closing any slides or anything that is open. And this is, I think, a review screen, and eventually you will get the option to end the examination. So these are all the instructions which are covered. Lastly, you have an option to click next. And once you click next, they are going to show you the summary. Okay. So here, because it is AA, they are showing you in the summary two things, that is section A and section B, because in AA, the format is different. There is just a 30-mark MCQ and remainder 70 marks is all calculation. I mean, all theoretical. You have to type everything here because AA is a theoretical paper. But when it comes to FR, there are three sections, guys. That is section A, section B, and section C. Section A and B will be MCQs. Section C is going to be constructed response. All my FR exams are already assigned. So is the reason why I wanted to show you this specifically. Is the reason why I click this examination. Then we'll get back to FR. You will click on next and they will ask you if you want to ensure that you want to begin the exam. You will click on yes and your examination will begin from now on. There will be a timer given to you on the right hand side. Here it is not mentioned because here there is no time limit. Okay, you can give the exam for however whatever period you want. Okay, otherwise they usually give you a point here. Okay, then you click on next. So they are showing you that section A covers all this. Once you click on next, you will be given your paper. Okay, you can see here the navigator, guys. I think the navigator is visible. It is besides me, navigator. So see, as this navigator opens, you can see all the questions. Okay, if you want to flag any question, you flag any question. Okay, and then it will also show you that which of the questions is seen or unseen. Okay, so if I have clicked this, I've seen this. I've seen the first question, right? But I have not solved it yet. So they are showing the status to be incomplete, right? Others have not seen yet. So they will write the status to be unseen. Okay. See, here you have different types. Like if you want to add any symbol like dollars or pounds, you can directly add the symbol to your values. Any sort of strike through it if you want to make. Any calculator that you want. As soon as you click on the calculator on the right hand side will open and you can directly just type whatever calculations you want to do, like 75 into 78, 74. Okay, and just press on equal to. I think yes. So enter. Yeah, enter. So I will get the amount on the right hand side, 5550. Okay. So you can use your calculator like that. Once again, if you click on the calculator, okay, how am I supposed to remove this? Yeah, you have an option of crossing it. So you can just cross it. Okay, and then there is a scratch pad. You can do all your typing here, whatever you want to type, whatever you want to keep notes of. While calculations, especially for FR, you need it, right? But it is better off to give a center-based examination because there you will be given a pen and paper, because see here, you already have two screens. The screen is split into left hand side being the question, right hand side being the question that you're supposed to answer, right? So technically guys, it is too much of split, and also if you'll add the scratch pad and everything here, it will be too much of clumsiness here. Okay. So you can use a pen and paper if you're giving a center based examination, which will be very easy for you. Okay. So these were certain instructions which were supposed to be given. I hope it is clear, guys. If in case any doubts, you can ask me in the comment section regarding the CBE platform. Okay. Now we actually jump to the FR examination. So let us start off with the FR examination. Okay. So your catalog opens. You can click on financial reporting, ACCA official resources. You can click on practice exams, and you can click on FR practice exam 2, and you can assign it. Here it is already assigned. So it is asking me to unassign if I want to. Then as you assign it, on the left hand side, your paper will be available to you. So FR practice exam 2, it is available. You can resume this paper. Okay. So it will show you, see, section A is starting. All the instructions are done with. Now section A is starting. That is what they are mentioning. And you can click on next. As soon as you click on next, your paper is going to start. Okay. So let us now solve one by one what are the questions and how we are supposed to actually answer them. Okay. I hope it is visible to all of you. Yes. Let us discuss it, guys. So, firstly, which of the following is a possible advantage of rule-based system of financial reporting? So, guys, as you all know, that in case of financial reporting, there are two systems, that is a rule-based system and a principle-based approach, right? Your financial statements are based on the principles. The accounting standards are prepared on the basis of principles. But obviously, accounting standards, you can say, is like a professional standard or a professional rule for a company that they have to follow to ensure that they are actually following a guideline and accordingly preparing their financial statements, right? So the rule based system, there are a set of rules, that is your accounting standards, and what is the possible advantage of it that we are supposed to identify. So the first one is it encourages exercise of professional judgment. Professional judgment cannot be encouraged by rule based, it can be encouraged by principle based, because then rules are just there. Okay, you have to just apply the rules. Where yeah, there your professional judgment is not scrutinized. So it encourages the exercises of professional judgment. No, that is not the correct answer. Then the second one, it prevents a firefighting approach to the formulation of standards. That is also not true, because there could be a possibility that there are some accounting standards which have certain complexities and which would answer different ways, right? Like if you remember in IFRS 15, I told you that before the introduction of IFRS 15, there were different accounting standards, but they were not correctly responding, or they were differently responding as to when and how we are supposed to recognize revenue. And here's the reason why there could be a possibility that there is firefighting, and technically that is not an advantage here. Okay. Third one, it offers accountants more protection in case of litigation. Yes, if the accountants have prepared the financial statements taking into consideration the accounting standards, taking into consideration the rule-based system which is available, so then obviously they will not be, penalized in case of any litigation. Correct? So obviously this will save the accountants because they have prepared the financial statements in accordance with the accounting standards. They have followed the rules. So it is an advantage to them. And the last one, it ensures that no standard conflicts with each other. That is also not true. There is a possibility that the standards might conflict and there are new standards which actually overtake, or you can say, overlap the new standards, the old standards. Okay. So technically only option C is going to be the perfect answer here. Right? You might be tested on everything, guys. Always keep that in mind. It's not just your calculation. It's not just your understanding of the accounting. It is just every practicality that you can determine through it. All those will be tested. Okay. So we click on next. Okay. Let us read through this question. Yeah. I'll keep it here. IFRS 10 Consolidated Financial Statements states that a parent shall prepare consolidated financial statements using uniform accounting policies. Okay, so he should prepare the financial statements using uniform accounting policies and for like transactions. Okay, it should be for like transactions and other events in similar circumstances. So technically, they should prepare the financial statements for similar circumstances and like transactions using the same accounting policies when they consolidate. That means they're asking you guys that, when one company consolidates with another company, the parent and the subsidiary should adopt the same accounting policies for similar circumstances or similar situations. Okay, or similar items, you can say. So, which of the following situations requires an adjustment because of this constraint? Okay, so you have to identify that which of the following situations genuinely requires an adjustment. Okay, firstly, the subsidiary has been acquired and its land is to be included in consolidated financial statements at fair value. So obviously, whenever a subsidiary is acquired, you are measuring all the fair value of all its net assets. That means it's all the lands and all the liabilities, all the assets and liabilities, correct? So that is not an adjustment required. That is done every time, right? So that is not true. You have to identify the one an adjustment because of which I mean an adjustment that is required because you have to match the accounting policies, right? A subsidiary carries its assets at historical cost, but the parent's assets are carried at revalued amounts. Yes, this is going to be the answer, right, guys? Because here there is a difference in the measurement. When it is a change in accounting policy, it is considered as a change in accounting policy when maybe there is a change in the measurement, a recognition, or a presentation, right? Here, the measurement, the value at which you measure your asset is different. The parent carries it at revalued amounts and the subsidiary carries it at historical cost. So the subsidiary has a different accounting policy, whereas the parent has a different accounting policy. So the subsidiary has to adjust with the parent and make it at revalued amounts. So here an adjustment will be required by the subsidiary. So option B is going to be the perfect option, right? The next options are there have been intragroup transactions during the year which have resulted in unrealized profit in inventory at the year end. If there are intra-group transactions, yes, there are adjustments, but those are not adjustments for changes in accounting policies. The accounting policies are same, right? Only the adjustments are required for intra-group trading. Then there has been intra-group trading which has resulted in intra-group balances for receivables and payables at the year end. That is also intra-group trading because of which there is a receivables for one entity whereas a payables for another. When they trade and on credit basis when they trade, they have their current accounts, correct? So when they have their current accounts, those are going to be cancelled and that is an adjustment of consolidation. That is not an adjustment for the uniformity of accounting policies. Okay. So the only adjustment that is going to be the right one is going to be option B. Okay, I'll click on next. Okay, let us read through the scenario first. The following trial balance extracts relates to Topsy Company as at 30th April 2016, wherein there is a land at cost at 30th April 2016. The cost of the land is 800. There is a building whose valuation at 1st May 2012 was 1500. Okay. Accumulated depreciation till 30th April 2015 is 90. Okay. And revaluation surplus which is stored at 30th April 2015 that is 705. Okay. So there is 705 worth of revaluation surplus which is stored and that is when on 30th April 2015. Okay. Your asset got revalued. Okay, valuation was 1500, correct? Now what they are saying that on 1st May 2012, when the carrying amount of the building was 7,50,000, it was revalued for the first time and its remaining useful life at that date was estimated to be 50 years, correct? So that means guys, this value that they've given 1500 That is a revalued amount, correct? Because on 1st May 2012, the carrying value of the asset was 7,50,000, but it got revalued to 1,500, correct? It got revalued to 1,500, or you can say 1.5 million. And on that date, its remaining useful life was, you can see here, 50 years, correct? Its remaining useful life was 50 years. So now, Topsy company, just a second, yeah. Topsy company has correctly accounted for this revaluation in the above trial balance. So they have done the accounting already. That is, it goes to OCI, right? Your evaluation surplus. However, Topsy company has not yet charged depreciation for the year ended 30th April 2016. Okay. Or transferred the excess depreciation from the revaluation surplus to the retained earnings as at 30th April 2016. That means it is the company's policy probably to transfer the excess depreciation to your retained earnings from the revaluation surplus, right? So technically, in 1st February 2016, I think it should be on, right? The land, but not the building, was independently valued to be $9,50,000. You can see the land cost is 800, right? At 30th April 2016, the land is 800, but it got independently valued to $9,50,000. And this adjustment has not yet been made for the year ended 30th April 2016. That means if this adjustment is not made, I have not fair valued my land again. Okay, and there is a fair valuation surplus. So I have not accounted for it within the financial statements. So I will do so. Right? Now they are asking me, what is the balance on revaluation surplus of Topsy company at 30th April 2016 after the required adjustments have been made? Okay. So firstly guys, your land originally was 750, correct? Land's original value was 750. Yes. Just a second, guys. Now it will be visible. So your land's original value is 750, right? You can see here $7,50,000. I'll take it as $7,50,000. And on that date, its remaining useful life, you can see here, was 50 years, correct? Its remaining useful life was 50 years, right? So that means the depreciation that should have been on this asset is 7,50,000 divided by 50 years, which is 15,000, correct? This is the original depreciation, right? This is the original depreciation. But my land got revalued to 1,500 on 1st May 2012, right? It got revalued to 1,500 on 1st May 2012. That means now it became 15 lakh, right? And its remaining useful life was 50 years. So what is the depreciation? 15 lakh divided by 50 years. That is going to be 30,000, right? So that means, guys, my asset had an original cost of 7,50,000 and originally the depreciation of 15,000. But because the asset got revalued, now the depreciation has changed to $30,000. Okay. So that means there is excess depreciation which is to be taken every year deducted every year from your evaluation surplus and taken to the retained earnings, right? Okay. So just remember one thing, that whatever is the revaluation surplus, from that you're going to take the excess depreciation, correct? Now, the revaluation surplus at 30th April 2015, you can see here, was 705, right? That means the balance at the start of the year was 705, okay? Then my land got revalued independently, correct? You can see here, where did that go? Yes, in February 2016, the land, but not the building, okay, was independently valued to $9,50,000. Its value was 8 lakh, but it got revalued to $9,50,000. So 7,05,000 is the opening balance. My land got revalued, so there is a revaluation surplus on the land. that is 9 lakh 50 minus 8 lakh, that is 1 lakh 50,000, right? And less the excess depreciation will be subtracted for this year, and that is 15,000, right? The excess depreciation is 15,000. So technically the value will be 7 lakh 5,000 plus 1 lakh 50,000 minus 15,000, which is the excess depreciation. So 7 lakh 5,000 plus 1 lakh 50,000 minus 15, that will give you 8 lakh 40,000. So the correct response is going to be option C, right? Because that is the amount which is stored in my OCI right now, correct? I did not take the revaluation from this. Always remember, it got revalued to 1500 and it was 750. I did not take that because they've directly given me the revaluation surplus which was there, right? So that means this is for that only, and they have transferred certain amount to retained earnings because it is their policy to transfer the excess depreciation. Is the reason why would not want to get into the calculations of it. I'll directly take I'll directly take the balance in the revaluation surplus, correct? Okay. So 8 lakh 40 is, I think, going to be the correct response. Moving on further to the next question. Okay. Now, Plow Company purchased 3,500 of the $10,001 equity shares of Steyr Company on 1st August 2014 for $6.5 per share. What is they are asking us? What are they asking us? Calculate the carrying amount of the investment in Steyr Company in the consolidated statement of financial position of Plow Company as at 31st July 2000. What is it? 31st July 2015. Right? So technically, guys, just a second. Am I supposed to focus? Okay, I'll keep it here. Yes. I hope this is visible to everyone. If it's not, I'll just maximize it a little bit. Yes. So technically, you have to calculate the carrying amount of the investment. Now see guys, this is an investment in associate. Okay, this is an investment in associate because see, 10,000 were the total number of shares, out of which I acquired only 3,500. So that means 3,500 divided by 10,000 into 100%. So I will get 35% to be the shareholding in the company, right? So technically I do not have control over the company because control is determined above 50%, and this is just a significant influence. So here we are going to calculate equity method of accounting. Here we are going to be using equity method of accounting. So as per the equity method of accounting, firstly we have to determine the cost of investment, right? Because I want to recognize the carrying amount of my investment in Steyr company. So I'll firstly calculate the cost of investment. I purchased 3,500 shares and each share had a value of $6.5. So $6.5 is the value of each share. So how much did I pay for it? 35,000 into 6.5. Sorry, 3,500 into 6.5. Yes, that is 22,750, right? I purchased not 35,000 guys, I purchased 3,500 shares. Right, 22,750 is the cost of investment. Now to this, what they are mentioning further, you can see here, Style Company's profit after tax for the year ended 31st July 2015 was 7,500, but Style Company paid a dividend of 0.50 per share, right? So firstly, we'll calculate that what is the profit share that we will get. Okay, because that will increase our cost of investment, right? I mean, that will increase our investment in associate, right? So technically, we have purchased 35% of the company I already showed you how. And the profits of this company was 7,500 into 35%. So it will give us 7,500 into 35%. That is 2625, right? But guys, I've already included the profit share. So whatever is the dividend that I have received from this company, that I will not include. So the company has paid a dividend, correct? So since the company has paid a dividend, that dividend will be subtracted because I have 35% shareholding of the company. So the company would have paid dividend to me also, right? So technically, what is the dividend that I have received? It is the total dividend of $0.5 or $50 into I was holding 3,500 shares. So technically in total, just a second, I'll just rewrite this part, right? It will be, I have each dividend that they've paid is $0.5 per share, right? You can see here, paid a dividend, oops, of $0.5 per share. So they have paid a dividend of $0.5 per share and I have 3,500 shares. So the value that I got is 0.5 into 3,500. I got 1750, correct? So that will be subtracted and the remainder of the value is going to be my answer, right? So 22,750 minus, sorry, plus the profit after tax, that is 7,500 into 35%, right? 2625 plus 22,750 minus 1750, that is going to give me 23,625, right? 23,625. I'll add the 3 zeros because they've asked me to calculate the total amount and tell me, right? So that is 3 zeros added to it. Okay, I think they are not asking because they've calculated it like this direct, right? So 23,625, I think that is going to be an appropriate response. We'll look at the solution also later on if in case there are any doubts. I'll click on next. Okay, now this is an easy question I feel because it looks small. Okay, indicate by clicking on the relevant boxes whether the following statements relating calculating the impairment loss of an asset are correct or incorrect. Okay, so you have to indicate and tell us whether the following statements are correct or incorrect. Let us look at it. Firstly, assets should be carried at lower of their carrying amount and recoverable amount. Correct? Yes, assets should be carried at lower of that, right? And here's the reason why you charge your impairment because your assets should be brought down to its recoverable amount. The second one, the recoverable amount of an asset is the higher of value in use and the fair value less cost to sell. Yes, that is also correct. That is technically the definition of your maximum recoverable amount that you can get from an asset. Okay, moving on to the next question. Which of the following statements is not true? In some countries, accounting standards can be a detailed set of rules which companies must follow. Do you think this is not true? It is true. You have to identify the one which is not true, guys. Okay? You have to identify the one which is not. So this is true because in some countries, accounting standards are a set of rules that the companies must follow. Right? The next question is, local accounting standards can be influenced by tax regime within a country. That is also true. Correct? Local accounting standards which are there, they can be influenced by the tax regime that, what are the laws and regulations in that country. According to that, the local accounting standards might be, changed or molded a bit. Okay. Accounting standards on their own provide a complete system of regulation. That is not true because there is professional guidance, there is professional judgments that we take. Then there is other things like your IFRS standards and IAS standards are there. But after that, there is also the principle based approach that you're supposed to focus on. So the accounting standards are not the only one, right? You can also rely upon the principle based approach, where in case you do not have a regulation or an accounting standard in place, you have to rely upon the principle based approach. That what does your principle say for an item, and accordingly how will you recognize that item. Accounting standards are particularly important where a company's shares are publicly traded. Obviously, it is only for the companies which are publicly traded, which are listed to the stock exchange. Okay, so all first, second and fourth, all three are true. Only the third one is not true, so we are going to answer that one. Moving on to the next question. Okay. A company had issued share capital on 1st January 2019 of 2 million $1 equity shares, right? On 1st October 2019, a right issue was made on 1 for 4 basis, which was fully taken up. Okay. On 30th September 2019, each share had a market value of $3.25, giving theoretical X rights price to be $2.84 per share. In accordance with IS 33 earnings per share, what is the weighted average number of shares in issue for the year ended 31st December 2019? Okay. So guys, firstly, when we calculate the weighted average, always remember for the right issues also there is a bonus which is included within the right issues. So whenever you calculate the value of your right issues, there is a bonus fraction which is to be applied since the start of the year till the date the right issues are made, right? So I will take the shares, then I will take the time fraction, I'll take the bonus fraction, and lastly I'll take the weighted average. Right? Firstly, a company at 1st January 2019 had 1 million shares, had 2 million equity shares of $1 each in issue. Right? So there are 2 million equity shares in issue at the start of the year at 1st Jan. Right? Now these shares are going to be there. This balance is going to be there for how long? Guys, they have clearly mentioned that the right issue is going to be made on 1st October. Right? So from 1st Jan to 1st October, this balance is there. This 20 lakh shares are only there. After that, after the right issue, the number of shares in the market will increase because the company is going to issue new right issues on 1st October. So from January to October, I mean to 30th September, the time fraction will apply because this is the balance number of shares. And it is January, February, March, April, May, June, July, August, September, right? So that is 9 months. So I'll put 9 divided by 12, right? Now for the right issues, what is the bonus fraction? It is calculating your term and then it is nothing but your theoretical X rights price. For the bonus fraction, it is nothing but your market value just before issue of your shares divided by your theoretical X rights price, right? This is the formula for bonus fraction to be applied for the right issue. Just a second, I'll erase this part. Yes. So the bonus fraction, you can see here just before the right issue, the market value of the shares was $3.25. So I'll take $3.25 divided by the theoretical X rights price, that is 2.84, right? So after calculating all this, that is 20 lakh into 9 by 12 to 9 divided by 12 into 3.25 divided by 2.84. The weighted average is nothing but 171,6549. 171,6549. It is nothing but 17,16,549. Okay. Then comes the next part, that is on 1st October, new shares are issued. So the new shares that are issued are your right issue, and right issue is given. You can see here right issue is given 1 for 4 bases, correct? You can see here 1 for 4 bases. That means for 4 shares that are already available, 1 right issue will be made. So 20 lakh into 1 divided by 4. Into 1 divided by 4. So the right issues are 5 lakh. So after the right issue, from 1st October onwards, the total number of shares will become 25 lakh. Right? The time fraction that will apply from 1st October till the year end, that is 31st December, correct? So October, November and December, the time fraction that will apply is 3 divided by 12. Always remember the bonus fraction is only applied since the start of the year till the date the right issues are made. The right issues have already been made on 1st October, so now the bonus fraction will cease to apply. Okay, so this is the only calculation that you're supposed to do, 25 lakh into 3 divided by 12. That will give you 6,25,000. Right? That will give you 6,25,000. I don't know how much is visible to you all. I think here if I come, it will be visible. So let us just do the total, guys. Can you all let me know the total? It is 6,25,000 plus 171, 6,549, which is going to be 2,341,549. Right? 23,41,549 shares. This is what we are getting. Let us see. Yes, exactly the answer that we got. 23,41,549 shares. I hope it is clear to everyone and you all have clearly understood the sum. Always remember, guys, right issue also has a bonus fraction to be applied, and bonus fraction is to be applied from the start of the year till the date the right issues are made. Okay. Moving on to the next question. Okay. Now here comes a little bit of tricky part, I guess, because they are asking about deferred tax. Deferred tax is a very interesting chapter, guys. You will find it very interesting, and it is also a little bit tricky and complex to understand. So guys, which two of the following would result in a credit to the deferred tax account? Okay, credit to the deferred tax account, that means deferred tax liability. Because of which of these scenarios will a deferred tax liability be created? When is a deferred tax liability created? When in the future date, I have to pay more tax, right? So obviously there is a temporary difference between the calculation of tax by the tax authorities, whereas the calculation done by us, because the tax authorities work on cash basis, whereas we work on accrual basis, right? So is the reason why there is a temporary difference arising. Because of that temporary difference, if in case I would have to pay more tax in the future date, then in such a case I will recognize it as a deferred tax liable. Okay. Firstly, let us look at this scenario, the first one. Interest which is receivable, which will be taxed when the interest is received. Today, the interest is receivable, so I have included that within my income in the P&L, right? Because as soon as it becomes receivable, I state it within the P&L, right? Interest receivable, right? It is stated as an income, and the journal entry will be interest income to interest receivables account debit to interest income, correct? So I stated as an income within the P&L, but the tax authorities will not consider it today because it has not received yet, right? The tax authorities work on receipt basis and paid basis, right? So tax authorities will not consider it today, correct? So that means as per my calculations, my incomes will be higher because I've stated that interest receivable as an income, and I will estimate a larger amount of tax to be payable. But the tax authorities, the actual amount which is to be paid to the tax authorities, that will be comparatively lower because they have not stated this as an income yet. It will increase my income and tax, right? But they have not included it. But in the future date, when I actually receive this income, At that time, the tax authorities will consider it, right? So at that time, I will have to pay more tax. So that means because of this, I will have to pay more tax in the future date. Then yes, this will result in a credit on the deferred tax account because it will be treated as a deferred tax liability. Okay. A loan, the repayment of which will have no tax consequences. If it will have no tax consequences, it will not give rise to a deferred tax liability or a deferred tax asset. So that means this is not the answer. Interest payable, which will be allowable for tax when paid. Interest is payable. I have recognized it as an expense today, but the tax authorities have not recognized it. Okay. But in the future date, when they actually recognize it, in the future date, my tax saving will be there because they will consider it as an expense at that time, right? So in the later date, they will consider it as an expense, and at that time I'll get a deduction for the same. So I will have to pay lower tax in the future date, right? So this is going to be considered as a deferred tax asset. It will not bring credit to the deferred tax account. Okay. It will bring debit rather. Okay. And then the last one, prepaid expenses which have been deducted to calculate the taxable profits of the previous year. Very tricky, guys. Just focus here. So there are certain prepaid expenses. Okay. Just a second. Yeah. There are certain prepaid expenses. Maybe say 10,000 are the total expenses which are paid already. 5,000 relate to this period, 5,000 to the next year, right? For 10,000 is the total expenses that I've already paid. 5,000 of which maybe say I've given a salary to an employee. His salary was 5,000. I've given him prepaid salary of 5,000 for this year, and sorry, I've given him the salary for this year of 5,000, and I've also given a prepaid salary of 5,000 for the next year, right? So technically, I have prepaid these expenses. So what is the journal entry that I will pass? The journal entry that I will pass is going to be expense account debit 5,000 because I'm paying him his salary. So that is an expense to me. Asset account debit, or you can say, yeah, asset account debit for the prepaid expenses. I'll just write directly prepaid expenses. Prepaid expenses are an asset to me because I've already paid for it, but I will still receive the benefits. The employee will serve me for the second year for it, right? So I will state it as an asset, and two, cash is going to go out of the business, right? Because I paid him already 10,000. This is the journal entry that I will pass. That means I have considered this as an expense for this year, but this amount that I've paid, that I've not considered as an expense because we work on accrual basis. In the next year, when he performs a service, then this prepaid expense will be treated as an expense and it will be removed. Correct? So the next year it will be treated as an expense. Right? But the taxable authorities, according to them, my total expenses are 10,000 because I've already paid for it, right? In this year itself, they will consider it as a total expense. So that means they will give me a deduction in this year itself. So on a later date, when I state this prepaid expense as an expense to the P&L, at that time they will not give me for this, correct? Technically, mainly for the 5,000. Right? See, they have given me a deduction for 10,000. 5,000 deduction I've already received because 5,000 expense I've already stated to P&L. But the remainder 5,000, that is also paid by me. So they have given me a deduction for that also already because they work on cash basis, right? But I have not stated it as an expense this year. So in the later date, I will state it as an expense, but the tax authorities will not consider it because they've already given me a deduction for the same, right? So that means on the future date, I will treat it as an expense, but the tax authorities will not because they already gave me a deduction in the previous year. So in such a case, the taxable authorities I will have to pay higher tax to the taxable authorities because they are not considering that 5,000 as an expense now, right? Because they already considered it previous year. So the option will be this, that yes, it is a deferred tax liability. Okay, because I'll have to eventually pay higher tax. I hope it is clear, guys. We'll move to the next question. Okay, so this is the question on revenue I see. IFRS 15, revenue from contracts with customers, states that where performance obligations are satisfied over time, states that when performance obligations are satisfied over time, entities should apply an appropriate method of measuring the progress. Yes, they have to apply an appropriate method of measuring the progress. I agree with that. Which two of the following are appropriate output methods of measuring progress? So, what do you consider from them as an appropriate output method? Right? Output method is nothing but actually going out there and certifying the work that 20% of the work is completed. So maybe you're hiring certain supervisors or someone to actually go to the project area and check whether how much is completed, and then he will accordingly certify the work. Okay. So total cost to date of the contract as a percentage of total contract revenue, no. This is technically considered kind of like an input method because we are taking the cost to date and everything. Physical milestones reached as a percentage of physical completion. Physical milestones which are reached as a percentage of physical completion. Yes, this can be considered because I'm actually checking that what are the milestones completed physically and accordingly determining, because I'm going there, right? So I'm checking that maybe I'm constructing a building. So I'm checking what is the physical milestone reached. Maybe I've constructed the first 2 floors. So accordingly I can determine, okay, this much percentage of the project is completed. Surveys to performance completed. Surveys, I'm conducting surveys to performance completed to date as a percentage of total contract revenue. Yes, this will be considered surveys to performance completed because I'm conducting surveys to ensure that what is the percentage of the total contract revenue which is completed. And lastly, labor hours expended as a percentage of total expected labor hours. This is technically calculated through the input method because it is the cost that are incurred and that is going to be incurred in the future date we are considering. Okay. So it will be option B and C most probably. I hope I get it right. Okay. Moving on to the next question. Okay. Pfeffer company has a current ratio of 1.2 is to 1. Okay. The current ratio is 1.2. I'll write here. Yes. It is 1.2 is to 1. That means nothing but what is the formula for current ratio? It is nothing but current assets divided by current liabilities, right? That means current assets technically is kind of 1.2 for every $1 of current liabilities, right? So, which is below the industry average. That means this ratio is below the industry average. Pfeffer company wants to increase the current ratio by the year end. They want to increase the current ratio. So what can they do? If you want to increase the current ratio, you'll either have to increase your current assets or you will have to decrease your current liabilities. If you increase the numerator, the ratio will increase, and if you decrease the new denominator, still the ratio will increase. So you can either reduce your current liabilities or increase your current assets, right? Now, which of the following actions taken before the year end would lead to an increase in the current ratio, right? So, which of these actions would suggest that yes, the current ratio would be increased? So, let us look at them. Return some inventory which had been purchased for cash and obtain a full refund of the cost. That means you purchase certain goods or something. Okay, you're returning those goods and you're taking back the cash. It is not true, correct? Because if you're purchasing, cash is going out, I agree. Right? Maybe you purchase for 10,000. Cash is going out. But inventory is coming in of 10,000. Correct? That means current assets are there. Right? It is just the current assets are adjusted. And if I'm taking the cash back, so cash account will be debited to inventory going out. Same 10,000. Right? So the current assets remain the same. There is no increase in the current assets, right? Because they are coming in, they are going out. If in case I will send this back, my cash will be increased by 10,000, but my inventory will be reduced by 10,000. So technically there is nil effect on the current assets. So they are not increased. So no, first option is incorrect. Make a bulk purchase of inventory for cash to obtain a large discount. That is also irrelevant to be honest, because if in case I make a bulk purchase of inventory I will get inventory valued at the cost only, right? Whatever is the cost. It does not make a difference. If the cost to me is 10,000 and minus I got a trade discount of 100 because of the bulk purchase. So 9,900 is the value. So that cost only I'll recognize for inventory, right? So it's not like if I got a discount, then that will increase my inventory worth, right? So even though I get the inventory, it will be recognized at 9,900, its cost only, because large discounts are deducted from the value of the inventory, and two, cash will go out of the business 9,900. So it does not make an effect on the increase in the current assets. It is still the same. So second option is also incorrect. Make an early payment to suppliers even though the amount is not due. Yes, this could be a reason, because if I make an early payment to suppliers, my cash is going out, but my payables are reducing, right? My cash is going out and my payables are reducing, but maybe say that my payables are maybe say 10,000. Okay. If I make an early payment, okay, if I make an early payment to the suppliers, so then I will get a discount on it, correct? That means probably I might have to pay cash of only 8,000, maybe I'll get a discount of 2,000. So my cash will go out. That means my current assets will reduce by 8,000. I agree. But my payables, my current liability will reduce by 10,000. Correct. So that means the current ratio, there is a possibility that it will increase. Right. So the option C is going to be the correct option. Offer early payment discounts in order to collect receivables more quickly. This could also be a correct option, guys, but I think more relevant would be this, right? If I'm offering early payment discounts, so I'm giving them a discount, so that much amount less will be received, but technically my current assets will also go down a little bit by the discount amount. So is the reason why this will not be the most appropriate answer. The most appropriate answer is going to be C. So as a professional, because you're going to be an ACCA, you have to use these professional judgments, guys, while determining that what is going to be the best effect. Okay. So you're going to be choosing option C. Now, don't worry, guys. This paper is a little bit tricky. Is the reason why I've chosen it for y'all. Otherwise, maybe in examination, until and unless you don't have a very bad luck, you will not be asked many difficult questions. Okay. But you'd never know. It's ACCA. Okay. It is their wish. If the examiner is in a bad mood, they might not correct, they might not give you a good paper. Okay. So on 1st October 2018, okay, we'll take a break now, guys. Before this is again huge sum that we are doing, we'll take a break now. We'll take a break of 10 minutes. After that, we'll return with the next questions. Okay. Okay, guys, I hope we are back. Let us continue with the remainder. I'll just shift it a little bit. Yes. Yes. Okay, guys, let us continue. On 1st October 2018, Picture Company acquired 60% shares in Frame Company. That means technically they have control over Frame Company because they have acquired more than 50% shares. So, Picture Company is going to be the parent company, whereas Frame Company is going to be the subsidiary company. Okay. At 1st April 2018, mid-year, the credit balances on the revaluation surpluses relating to Picture Company and Frame Companies equity financial assets investments stood at 6,400 and 4,400 respectively. Okay. Now 6,400 and 4,400 respectively, this is already there. Okay. This is the 6,400 will be stated in the consolidated revaluation surplus because that is of the parent. But 4,400 are pre-acquisition, guys. Always remember. So pre-acquisition revaluation surplus of the subsidiary company, that is their own revaluation surplus, we are not entitled to it, and is the reason why we will not show it within the consolidated financial statements. Okay. The consolidated revaluation surplus, we are not going to show 4,400. We are going to deduct this value while calculating the goodwill. Right? It is in working note 3. If in case you want to understand consolidation in detail, you can actually go to our previous lectures. In the previous quarter, we have done on consolidation. There you can understand that why this 4,400 in detail is not included, because technically they are pre-acquisition revaluation surpluses which we are not entitled to, because after we acquired that, this is the revaluation surplus stored before that, right? After we acquired it. So technically this we are not entitled to, and this will be deducted in calculation of goodwill. Okay. The following extract was taken from the financial statements for the year ended 31st March 2019. That is, other comprehensive income had a loss of fair value on equity financial asset investments. They had a loss for the current year, that is 1400 loss and 800 loss. Right? Now this is at the year end. Okay. This is at 31st March 2019. That is the year end. Okay. And also remember that the acquisition was on the acquisition was on 1st October, right? The acquisition was on 1st October. Now, guys, the acquisition was on 1st October, and our losses for the year is 800 on the equity investments. But we have acquired the company when? Yes, on 1st October only, right? We have acquired the company on 1st October only, and our losses for the year is 800, correct? Now, the following extract was taken from the financial statements for the year ended 31st March 2019. Assume that the losses accrue evenly throughout the year, and according to that, you are supposed to actually provide that what is going to be the amount in the revaluation surplus for the consolidated statement of financial position of Picture Company as at 31st March 2019. Okay. So I hope the question is pretty clear to you all. We have acquired the company on 1st October, that is mid-year. Okay. And the start of the year, they had credit balances of 6,400 and 4,400. Now, for the parent company, obviously, it will be included. 6,400 will be stored in the consolidated revaluation surplus. And we had acquired the company on 1st October, that is mid-year, correct? And we have to prepare to 31st March. This loss relates to the full year, correct? So that means this loss will deduct the revaluation surplus because it is occurring in between the year, correct? So 800, and we have acquired the company 6 months back, that is from 1st October to 31st March, only 6 by 12, and into we have acquired 60% of the company. So only this much loss we are going to bear, 800 into 6 by 12 into 60%. That is 240. Correct? The revaluation loss that we take is only of the subsidiary companies 60% that we have. Right? Like we take the revaluation surplus, we can also take the revaluation loss of 240, and we have a revaluation loss of 1400. So that will also be deducted. Right? So in the statement of other comprehensive income, in my revaluation surplus accumulated balance, it will be 6400 minus 240 minus 1400. It is the parent company's 1400 loss, so that will be completely stated. Okay. So 6400 minus 240 minus 1400, that is going to be 4760. So our answer is going to be here. Okay. 4760. That is option B. I hope the sum is clear to you all. Always remember, the loss is throughout the year, right? Other comprehensive income, loss on fair value of equity, financial assets, investments is 800. We have acquired the company just 6 months back, so we will charge only 6 months of loss, and we will only charge the loss that is accrued to us. Okay. So that means 60% of the loss, because we are acquiring 60% of the company. The remaining 40% loss will go to NCI. Okay. So 4760 is going to be our calculation. I hope it is clear to everyone. We'll move to the next question. Okay, guys. A local authority department is responsible for waste collections. Okay. So they are collecting all the waste. They have an annual budget to provide a regular collection service from households in local area. Okay. So they are collecting all the waste from the households in the local area, and for that there is a budget. Budget was increased to enable department to increase the percentage of waste disposed of in an inventory in a friendly manner. That means technically probably just recycle the waste which is disposed of. That percentage they want to increase, because they want to increase the amount of waste which is recycled. So for that their budget is going to be increased. So which of the following is the best measurement to justify the increase in the budget? That means from which you can identify that yes, the budget has been increased in a proper manner, right? So firstly, you have an option, this one, which is an increase in the number of collections made during the period. That does not correctly measure, right? It is not measuring the percentage value that how much is recycled and everything. The percentage of waste recycled rather than being placed in landfill slides. Yes, this could be correct, right? You can identify the percentage of waste which is recycled to identify the waste which is disposed of, right? So technically you can take that into consideration. And the fair value of the machinery used in making the collections, no, that is irrelevant. And a breakdown of expenditure between the cost of making collections and the cost of producing waste. You can just break down that, but that will not give you a best measurement of the budget. I think the best measurement will be depending on the waste recycled, right? So you will identify that how much of the waste should be recycled this year, or accordingly how much of the budget should be increased, right? So maybe say in the previous year, my waste that was recycled was 30%, right? Maybe say $2,000 worth of waste was recycled. For that, I incurred $2,000 of cost to recycle it. Now, maybe in today's date, if I want to actually recycle 40%, so then I will have to incur more cost, like maybe $3,000, right? So, is the reason why I think this will give me an appropriate measurement, that the percentage of waste recycled rather than being placed in the landfill slides. This is going to be an appropriate answer given, right? Moving on to the next question. Okay. Seems to be a big question, but also seems to be easy enough to be dealt with. This is question number 30. Okay. So last 3 questions of section A. After that, we'll jump to section B. Okay, guys. Panther Company owns 80% of Tiger Company. Okay. Panther Company is owning 80% of Tiger Company. An extract from the company's individual financial statements of financial position as at 30th June 2008 shows the following about Panther Company. Firstly, they are owning 80%, so it is consolidation, right? Panther Company owns Tiger Company 80%, and they've owned this company when? Okay, they've owned it for whatever date because they've not mentioned. Now, technically, they are actually at the year end 30th June 2018. These are the financial statements information provided to me. So there is property, plant and equipment at a carrying amount. For Panther Company, it is 3,70,000, and for Tiger Company, it is 2,85,000. So technically, usually what we do, we just consolidate 3,70,000 plus 2,85,000 and take the total, right? But there is also one more adjustment here. On 1st July 2017, Panther Company sold a piece of equipment with a carrying amount of $70,000. Panther Company sold a piece of equipment of $70,000 to Tiger Company. Okay. And they sold it for $1,50,000. Right. The equipment had an estimated remaining life of 5 years when it was sold. So what is the carrying amount of the property, plant and equipment in the consolidated statement of financial position? Firstly, guys, these values that they have 3,70,000 and 2,85,000, this from this value it is already deducted, right? Because it is at the year end provided to you. So here there was an asset of 70,000. That means Panther Company had assets worth 3,70,000 plus 70,000, and that 70,000 worth of asset was sold to Tiger Company. So Tiger Company included this asset of 1,50,000, right? Minus 1,50,000. So technically Tiger Company purchased that asset for 1,50,000. That 1,50,000 is included in this. Okay. But the thing is that, yeah, guys, here is that the asset was worth $70,000, but Panther Company sold that asset to Tiger Company for $1,50,000. So, firstly, this is an intra-group trading, okay, and this is an unrealized profit which is earned by the Panther Company through intra-group trading, right? By selling a non-current asset to the subsidiary company, right? So any unrealized profit related to it shall be eliminated. Okay. Now they sold it when? On 1st July, and you have to prepare for 30th June. So whatever is the calculation, that will be for the full year only, right? Whatever is the calculation, that will be for the full year only. Firstly, guys, always remember there is a method, or you can say a way to actually simply calculate the sale of non-current asset and the unrealized profit on it. You just have to take with transfer, without transfer, and the PERP adjustment. Okay. With transfer, the asset is sold for $1,50,000. So its cost with transfer is $1,50,000. Without transfer, it had a carrying amount of $70,000. That means by selling it, 1,50,000 minus 70,000, the seller has earned a profit of 80,000. Correct? From this, the depreciation is charged, okay, for the full year, and its remaining useful life you can see here was 5 years, right? Its remaining useful life was 5 years. So the depreciation that is going to be charged is 5 years, 1 divided by 5. So 1,50,000 into 1 divided by 5, that is going to be 30,000 depreciation, and 70,000 into 1 divided by 5, that is going to be 14,000. Right? So there is an excess depreciation which is charged by the subsidiary company because obviously they purchased the asset at $1,50,000, right? But the original depreciation should have been $14,000. So the difference between the two depreciations is 16,000, which is excess depreciation charged. So eventually the carrying amount is going to be 1,20,000 here, 56 here, and 64,000 here. Okay. So always remember guys, this is the profit which is earned by the parent company. This shall be reduced from the group retained earnings. This is the excess depreciation which is charged by the subsidiary company because they purchase the asset at a higher value. So this should be added back to the working note to net assets of subsidiary company. And this is the net adjustment to be made. I mean the net deduction to be made in the value of the non-current assets on the face of statement of financial position. Okay. Because technically your non-current assets should have been reduced by this value, right? Because the subsidiary company has included 80,000 in this, right? Sorry, 1,50,000 in this, but he should have taken only 70,000, correct? He should have taken only 70,000, but he has added 80,000 because obviously he purchased the asset at 1,50,000, correct? So he included additional 80,000, so that shall be eliminated. 80,000 should be eliminated, but by the year he has also reduced it by additional 16,000. He should have reduced the depreciation only by 14,000, and is the reason why the net reduction will be 64,000. So technically, simply understanding guys, it will be 3,70,000 plus 2,85,000 minus 16,000. Sorry, minus how much was it? 56, right? Just cancel this. Minus 56,000. So you will get, sorry, 64,000. Where am I? What am I doing? It will simply be 3,70,000 plus 2,85,000 minus 64,000. So it will be 3,70,000 plus 2,85,000 minus 64. That will give you 5,91,000. Let me match it. Right? 5,91,000. I hope the sum is clear to you all. If in case any doubts, you can ask me directly in the comment section. Okay. So on 1st July 2017, Lime Company acquired 90% of Soda Company's equity share capital. That means technically it is their subsidiary company now. They have purchased the company. On this date, Soda Company had internally generated customer list. Internally generated are not going to be recognized as an intangible asset, but if it is acquired by that subsidiary by the parent company, then it will have value, right? Then it will not be anymore be internally generated, right? So internally generated customer list was valued at $35 million by an independent team of experts. So you have an appropriate valuation of the customer list and it has been purchased by the parent company anyway, right? So at 1st July 2017, Soda Company was also in negotiations with the potential new major customer. If the negotiations are successful, the new customer will sign the contract on 15 July 2017 and the value of the total customer base would then be 45,000 million worth, right? Now that is not yet recognized. They are just saying that it will be worth in the future date. That I can say that in the future date I might be worth this much and that much. That is inherent goodwill, right? That cannot be considered. But the customer list, it is available on that date. Its value can be reliably estimated to be $35 million and the parent company has paid for it while purchasing it. So we can only recognize 35 million. So what amount would be recognized for the customer list? Only $35 million, not the amount which has not yet been settled because they are under negotiations yet. They have not finalized the contract. Okay. Moving on to the next question. Okay. Now this is the last question for your section A, guys. After this, we are going to jump to section B. Identify by clicking on the relevant boxes whether the following statements relating to goodwill are correct or incorrect. Okay. So you have to just identify whether the relevant boxes, identify by clicking the relevant boxes, whether the statements regarding goodwill is correct or incorrect. Goodwill is amortized over its useful life with the charge expense to P&L. Goodwill is amortized. Is goodwill amortized, guys? Obviously not, because goodwill has an indefinite useful life. Correct? Goodwill is an intangible asset, the purchased goodwill, and it has an indefinite useful life. So in such a case, the goodwill cannot be amortized. So this statement is incorrect. On investment in associate, any related goodwill should be separately identified in the consolidated financial statements. So technically this is also inappropriate, because guys, when we calculate the investment in associate, we just directly take the cost of investment in the associate, right? In that the goodwill and everything is included, because obviously whatever is the cost of investment, that would be probably higher, right? So this is also incorrect. The testing of goodwill for impairment is only required when circumstances exist which indicate potential impairment. So the testing of goodwill for impairment, it does not matter whether the goodwill has an indication of impairment or not. The goodwill is having an indefinite useful life, and is the reason why, irrespective of the fact that there is an indication or not, goodwill is going to be tested for impairment annually, right? So the testing of goodwill for impairment is only required when circumstances exist which indicate potential impairment. That is incorrect, because whether or not there are any indications, your goodwill will be tested for impairment, right? If the fair value of a subsidiary's contingent liabilities can be reliably measured, that means if in case there is a contingent liability whose fair value can be reliably measured, so then in such a case you can probably recognize it as a provision, okay, at the date of acquisition, and obviously the parent company will consider it while purchasing this company, because now they think that if in case it is reliably measured, then net assets that they will get from the subsidiary company, that will be lower, correct? Because the liability would actually be they would have to pay for it in the later date, right? So they should be included in the consolidated net assets. Yes, they will be included. Yes, and it will obviously increase the amount of goodwill, because amount of goodwill will anyway be increased, because guys, simply your goodwill is going to be fair value of net assets. Sorry, your goodwill is going to be the amount that is paid minus fair value of net assets. By actually considering a liability, your fair value of net assets will reduce. So then the amount which is paid will be higher, and thus your goodwill will be higher. So the last option is correct. Okay. With this, our section A is done with, guys. I hope it is clear to you all. Now we'll take a short break again of 10 minutes, because I see my annotate is not available, so I cannot write anything. And also we are starting with a new section. Before that, we'll take a 10-minute breather break, and after that we'll return with section B questions. Okay. Okay, guys, let us start with section B questions. So in section B questions, guys, you will be given a big scenario. Okay, you can see the scenario on the left hand side, and based on this scenario, you will be having 5 questions to deal with. Okay, so the first question is, in accordance with IS 16 property, plant and equipment, what is the value of additions to plant for Artem Company for the year ended 30th June 2015? That means there would be certain additions. Now, which additions of these would be capitalized and which would be not capitalized, that we are supposed to identify and accordingly calculate the value of the additions, right? So they purchased a new plant. During the year ended 30th June 2015, the company the company spent 5,50,000 on new plant as follows: 5,25,000 on the cost, 3 on the delivery, on building alterations to accommodate the plant 12 has been incurred. Cost of initial testing of the plant, it is 2,000 which is incurred, and plant operator training cost 8,000 which is incurred, right? So guys, which of these values would be capitalized to the additions, right? Firstly, obviously, whatever is the purchase price, the plant cost, that will be added 525, correct? 525 is going to be added. Then, I'm so sorry. Yeah, 525 will be added. Then, delivery to site. For delivering the plant to the site, it will be added because these are transporting costs which are incurred to deliver the plant to its current location and condition, right? So, delivery to site will be added. Any sort of building alterations to accommodate the plant? Yes. If in case I need to make alterations to the building to accommodate the plant, it is to be capitalized to the value of the plant. Cost of initial testing of the new plant, testing stage, it will be capitalized to the value of the plant. Plant operator training costs. So that means I'm incurring certain training costs for teaching the operations of the plant, probably to my laborers. Okay. So then in such a case, what will happen, guys? No matter how much ever training costs I incur on my laborers, I cannot control their behavior. I cannot control them, right? So if they want to leave the company, they might leave the company. If they do not want to perform well, they will not perform well, right? So no matter how many training costs I incur, I do not have control over my employees, over my laborers, and is the reason why training costs are never capitalized to the value of the plant. So this 8,000 will not be capitalized. So only this 4 will be capitalized, which is 525 plus 3 plus 12 plus 2. 525 plus 3 plus 12 plus 2. 5,42,000 is going to be the value of the plant, the value of the additions to the plant, right? So, in accordance with IS 16 property, plant and equipment, what is the value of the additions to the plant for Atom company? We just calculated it to be 5,42,000, right? I hope this sum is clear to you all. This was a very straightforward and easy sum. Moving on to the next question. Which of the following in relation to a change in the remaining useful life of the furnitures and of the fixtures and fittings are true? Okay. So you have to identify the one which is true relating to your fixtures and fittings. This is the scenario I think to which this question is related to. Atom Company's fixtures and fittings were purchased on 1st July 2012 and the cost of purchase was $50,000. The directors have depreciated them on a straight line basis over an estimated useful life of 8 years, assuming 5,000 residual value. Right. So technically, what is the depreciation here? 50,000 is the value of the asset minus 5,000, the residual value. 5,000 is not going to be depreciated, guys. Divide by its useful life of 8 years, correct? Where is it? Where is it? Yes. 8 years of useful life. So divide by 8 years. So the depreciation will be 45,000 divided by 8 years, which is 5625. 5625 is the depreciation per annum, right? And this was purchased on 1st July 2012. And at 1st July 2014, that means after 2 years. So firstly, we'll calculate the carrying value, right? for calculation of the carrying value, the original value of the asset is 50,000. From this, the depreciation we are going to charge for the first year 5625 and for the second year 5625. Correct? Because we have to calculate from 1st July 2012 to 1st July 2014. That means after 2 years. So after 2 years, the carrying value of the asset is going to be 50,000 minus 5625 minus 5625, which is going to give us 38,750. Okay. So just remember guys, 38,750 is the carrying value of the asset and the depreciation charge to date is 5625. Okay. The directors realize that the remaining useful life of the fixtures is now 5 years. Okay. The remaining useful life of the fixtures is now 5 years. And there is no change to the estimated residual value. That means the residual value remains the same. Only the value of depreciation is changed. Okay. Because the useful life has changed. So the carrying value is 38,750. Right. From this, my residual value obviously will be subtracted and it will be divided by the new useful life, that is of 5 years. From 1st July onwards, the depreciation will thus be 38,750 minus 5,000 divided by 5 years. That is going to be 6,750. Okay. So previously the depreciation was 5,625. Now it is 6,750 because there is a change in the estimated useful life of the asset. Okay. Now let us look at the question. Which of the following is true in relation to the change in the remaining useful life of the fixtures and fittings? Now obviously this is a change in the accounting estimate guys, because relating to the asset, whatever is the useful life, whatever is the residual value, these are just estimates which are taken on by the entity considering the marketing conditions on that date when it was purchased, right? So if these are estimates, changes are bound to occur in this. Okay. And any change in accounting estimate, if you go through IAS 8, a change in accounting estimate is to be dealt with prospectively, right? That means the sum that I showed you, that previously the depreciation that was charged was 5625. Now the depreciation that will be charged is 6750. So technically I am not going back and changing the depreciation of the previous years. I'm just changing the depreciation to be charged in the current and the future years, right? So that means it is dealt with prospectively. Retrospectively means going back and changing. Prospectively means changing in the current and the future years to come, right? So depreciation, what did I do? I charged it in the previous year. I changed it in the previous year, and in the future years, I'll depreciate it under a different value. Correct? That doesn't mean I'm going to go back and change the value because previously only 5625 was charged, right? So that doesn't mean I'm going to go back and change the value of the previous years. So technically, a change in the accounting estimate is to be dealt with prospectively. So obviously, a change in the depreciation estimate is a change in accounting estimate, which will be dealt with prospectively. Okay, which should be prospectively applied. So I hope this sum is clear to you all. Okay. In accordance with IS 16, property, plant and equipment, what is the depreciation charge for the furnitures, for the fixtures and fittings for Atom Company for the year ended 30th June 2015? We calculated, right, from 1st July 2014 at the year end 30th June 2015, the depreciation, we calculated the new depreciation considering the new estimated useful life of the asset. We calculated it to be $6,750. Okay. So I hope this sum is clear to you all. We have already calculated it. So see, just by doing one thing, we got 4 marks directly. Okay. If we in case calculated wrongfully, we might also lose all the marks. Okay. So always pay attention while doing the questions of section B. Okay guys. Now let us look at the next part. I don't know how much of this is visible. Yes, I'll just stay like this. So I think it will be visible. In accordance with the IF 38 intangible assets, the $25,000 cost incurred on the research project during the year ended 30th June 2014 should be what? Okay. Firstly, what will be its accounting treatment they are asking? So you could be asked question like these. Okay. You have to pick the one that you find correct. You pick it and then you post it in that box. So what do you think would be the accounting treatment, and what do you think would it be considered as a research cost, or as a future economic benefit, okay, or as a machinery that will be put into use once it is completed, right? They are asking you. Now let us look at the scenario and then decide whether what will it be treated as. Okay, so this is the scenario, I guess. Art and Company began a research project in October 2013 with the aim of developing a new type of machine. Right, so he has just started the research of the project on 1st October 2013. If it is successful, Art and Company will manufacture the machine and sell them to the customers, as well as using them in their own production processes during the year ended 30th June 2015. Costs are $25,000 will be incurred on conducting feasibility studies and some market researches. So technically, I'm just doing the studies right now. I'm at a very early stage where I'm just researching, right? If in case I'm doing the application of it, then it's a different case. I'm just doing the some research. So if in case for research, I've incurred certain feasibility studies, whether how this project will be feasible, how I will be able to complete the project and everything. For that, I'm incurring costs of $25,000. So obviously these $25,000 are at a research stage, so they will not be capitalized as property, plant and equipment, rather will be expensed to P&L. During the year ended 30th June 2015, a further $80,000 were incurred on constructing and testing a prototype. So that means I am applying the research findings that I've done. So application of the research findings where I'm at the testing stage and the constructing stage, from that stage I will start to capitalize it. Okay. So 80,000 will be capitalized, 25,000 will be expense to P&L. Always remember that 25,000 which is once expense to P&L on a later date cannot be capitalized to my intangible assets as a development cost. Okay. So firstly, accounting treatment of that $25,000, it will be written off to P&L. So I'll just pick this box. Okay. And I will post it here. Okay. Written off to P&L. And the other scenario, they are saying, yes, it will be visible like this, right? What is the reason of not capitalizing it? As they are research costs at 30th June 2014. Obviously, they are not future economic benefits. They are not machinery which has been completed. So they are obviously research costs at 30th June 2014, right? And is the reason why I am expensing them. I am writing it off to P&L. So this will be the correct response to it. I hope it is clear to you all. And moving on to the next question. Okay, guys. In accordance with IS 38, which of the following is true when Atom Company moves to the production and testing stage of the prototype? Obviously, once he moves to the testing and testing stage of the prototype, from that date you will capitalize whatever costs you've incurred. Right? So let us see what they are saying. The project has moved to development stage. If IS 38 development expenditure criteria are met, Atom Company can choose whether or not to recognize the $80,000 cost as intangible asset. Then he does not have to choose. Then it is better off for him to capitalize it, right? So whether or not to recognize the $80,000 cost as an intangible non-current asset. Yes. So I think this would be appropriate, but let us look at the whole scenario. The project is still at the research stage. Obviously, it is not at the research stage, so this is definitely wrong. The project has moved to the development stage. If IS 38 development expenditure criteria are met, Atom Company must recognize $80,000 cost as an intangible asset. I think this will be the most appropriate. It should meet all the criteria of IS 38 for constituting any cost to be recognized as a development cost and thus capitalizing them as an intangible asset. So the project has moved to the development stage as per the IS 38 development criteria, you will capitalize the costs incurred after the development stage. The project is still in the research stage. Obviously, it is not in the research stage, so I can directly ignore that. So I think option C will be the most appropriate option here. Moving on to the next part. Okay, so we have dealt with all the questions which are related to this scenario 1. Okay, section B questions of scenario 1. Now there is second scenario that is there, and related to this scenario there will be 5 more questions to be dealt with. Okay, so let us read through the scenario, guys. Macon Company, we are reading this scenario. Macon Company prepares its financial statements to 30th September each year. Macon Company's draft financial statements were finalized on 20th October 2013. Okay, so that means they have been, their year end is 30th September, but their draft financial statements are prepared at 20th October. Sorry, guys, 20th October 2013. That means these are relating to the adjusting and non-adjusting events. They were authorized for issue on 15 December 2013. Okay, so they were authorized on 15 December 2013, and the annual general meeting of stakeholders took place on 23rd December 2013. Technically, what are adjusting and non-adjusting events? These are events which occur after the reporting period, but till the date the financial statements are authorized for issue. Right? So you will take from 30th September to 15 December, whatever are the events, they could be adjusting or non-adjusting events which we'll take into consideration. Okay. Now let us see what they are asking for. Indicate by clicking the relevant boxes whether the following statements are correct or incorrect for Macon Company in accordance with IS 10 events after the reporting period. All events which occur between 30th September 2013 and 15 December 2013 should be recognized as events occurring after the reporting date. Yes, correct. All events which occur between this date is going to be recognized as should be considered. Yes, it is not like recognized because non-adjusting events are not recognized, right? They should be considered as events after the reporting date. Yes, this is correct. An event which occurs between, so we are reading this one. Okay, not able to select it. An event which occurs between 30th September 2013 and 15 December 2013 and provides evidence of a condition that existed at 30th September 2013 should be considered as an adjusting event. Obviously, this is also correct. Something which can be classified as an adjusting event is nothing but for it, there were certain existing conditions at the reporting date, and now any changes to it is just providing an additional evidence for the same, so we can adjust that. For example, I had receivables at the year end 30th September, and later on there are certain bad debts. So I had receivables, correct, and now the customer is unable to pay me, right? So the customer being unable to pay me is just the additional evidence of the receivables that were there at the reporting date of the company. So that can be adjusted in the opening balance. So this is also correct, right? Moving on to the next question. Okay. In accordance, I hope this is readable to all of you. I have to keep it here. Yes. In accordance with IS 10, indicate by clicking on the relevant boxes whether the following events would be classified as adjusting or non-adjusting events in Macon Company's financial statements for the year ended 30th September 2013. Okay, let us look at the scenario. During October 2013, there was evidence of a permanent diminution in a carrying amount of a property held at 30th September 2013. So there is a permanent diminution in a property, okay, during the year October 2013. Now this is after the year end of the company, correct? So that means it could either be adjusting or non-adjusting event. Now I am not sure whether what will be the consequence for this, but I feel if it is a permanent diminution in the carrying amount of a property, it should be technically a very big amount which is to be considered, which is technically we had the property as an evidence, we had the carrying amount of the property at 30th September, and it is just providing an additional evidence that it is being diminuted permanently. So technically, it might be an adjusting event. Okay. But we are not sure about this. We will look through the solution and see for their response on a later time, right? Once we are done with the paper. On 1st December 2013, the acquisition of a subsidiary was completed. A new subsidiary company was purchased. The whole subsidiary company cannot be adjusted for, because for that we will have to prepare separately consolidated financial statements and everything. There are a lot of components that is to be dealt with. So obviously it is a non-adjusting event irrespective of the fact whether the negotiations were there at the year end. Okay. The sale of inventory during October 2013 at a value less than its cost. Now, the inventory was there within the financial statements. It is just sold at a value lower than its cost. So that means the evidence was there. It is just, the conditions were there that there was inventory at a value within the financial statements at the year end. By selling them at a value which is less than cost is just an additional evidence for the existing condition. So this is going to be an adjusting event. Lastly, the insolvency of a major customer during October 2013, whose balance was included within receivables. Obviously, this is also going to be an adjusting event, guys, because his balance was there, his receivables were there. Correct? I gave you the same example. Receivables was there, but after that he is unable to pay. So that means we will consider it as bad debts and it is going to be an adjusting event. Okay. So I hope it is clear to you guys. I am not sure about the first one. We will look for it once we go through the solution. Okay. Now, let us look at the next scenario. What is the total amount charged to make on company's statement of profit or loss in respect of the property year ended 30th September 2013? Okay. So, let us look at the property. I think it is related to this scenario. On 30th September 2013, Macon Company moved out of one of its properties and put it up for sale. Okay. They moved out from one of its properties. That means from 30th September 2013 onwards, they are going to classify it under IAS 40. Right? Because they are using it for the purpose of held for sale. Correct? That is not an owner occupied property. Okay, and that is on 30th September 2013. On 1st October 2012, the property had a carrying amount of 2.6 million and a remaining life of 20 years. Okay, so before it was moved as held for sale, guys, before it was classified as held for sale, okay, it is held for sale, so probably it might be classified under IFRS 5, not IAS 40. Okay, it will be classified under IFRS 5. Because it is not held for capital appreciation, they are saying it is held for sale. Okay, at the year end it is held for sale, but before the year end, that is on 1st October, that means at the opening, the property had a carrying amount of 2.6 million and a remaining useful life of 20 years. Correct. So at the start of the year it was 2600, right? You will charge depreciation on it because firstly it was used. Correct. So the depreciation will be 2600 divided by 20 years. That will be 130. 130 will be deducted and the remainder value will be our carrying value at the year end, that is 2470. Correct? The property is held under the revaluation model and the property was expected to sell for a gross amount of $2.5 million with selling costs estimated to be $50,000. Okay. So property was held at its fair value, correct? I mean, at the revaluation model, and the property was expected to sell for a gross amount of $2.5 million, but the selling cost to be incurred were $50,000. Its carrying value, guys, is 2470. Its fair value rather is 2.5 million, correct? Its fair value is 2.5 million. So, from that, just a second. Oops. So at the year end, its carrying value was 2470. but it could be sold for 2.5 million, that is 2,500. I'll just erase this. Yeah, it could be sold for 2,500. But if you remember, once it is classified under IFRS 5, it is to be held at lower of carrying amount and fair value less cost to sell. So carrying amount we have identified, it is 2470, and fair value less cost to sell is nothing but 2500 minus 50,000. So that means minus 50, it is 2450. Correct? It is 2450. So we have to identify that what is the amount charged to make on company's P&L in respect of the property for the year ended 30th September 2030. So technically guys, depreciation will be charged for 1,30,000 year, correct? We are going to charge depreciation to P&L because for the full year the asset was there, correct? At the end of the year it is classified as held for sale. So for the full year I charge depreciation, and also what else will go to P&L? Now I have to take my asset under IFRS 5 at lower of carrying value and fair value less cost to sell. So the lower of these two amounts is this amount, correct? So my carrying value is 2470. When I take my asset at held for sale under IFRS 5, when I take my asset as held for sale under IFRS 5, I will have to take the lower of these two, and its carrying value was 2470. So that means guys, if its carrying value is 2470, I'll have to bring it down to 2450 because that will be the value of my asset under IFRS 5. So I will also charge impairment of 20,000, correct? Or you can say 20 worth of impairment, right? So firstly, I have already charged the depreciation of 130 and I'll charge an impairment of 20. So 130 plus 20, the total amount that will be expensed to my P&L is going to be $1,50,000, and that option is given to you here. So we'll select that option, right? I hope it is right. I have not gone through it guys. I'm sorry. Yeah, but I hope it will be correct. Okay. In accordance with IFRS 5 non-current assets held for sale and discontinued operation, what is the carrying amount of the plant in Macon Company's statement of financial position as at 30th September 2013? Right? So I think there is one more scenario given to us for the plant. Let us look at that plant. Macon Company decided to sell an item of plant during the year ended 30th September 2013. On 1st October, that means the opening, the plant had a carrying amount of 4,90,000. Okay. So the plant firstly had a carrying amount of 4,90,000 at the start of the year. Okay. And a remaining useful life of 7 years. Okay. The plant met held for sale criteria on 1st April. That means you will charge depreciation only till 1st April, because once plant is held for sale, then no depreciation is going to be charged, because since it is held for sale, the company is not going to be able to make use of it, right? The company should not be making use of it. So there is no wear and tear of the asset. So you're not going to depreciate your asset, right? So depreciation shall be charged into 1 divided by useful life of 7 years. But depreciation will be charged only from 1st October till 31st March, because from 1st April it is classified as held for sale. So October, November, December, January, February and March, only 6 months depreciation you will charge. So it will be 4,90,000 into 1 divided by 7 into 6 divided by 12. The depreciation will be 35,000. Thus, the carrying value of it will be 35,000 subtracted from 4,90,000, which will be, just a second, guys. Yes, which will be 4,90,000 minus 35,000, which is going to be 4,55,000. Correct? So, at 1st April 2013, the plant had a fair value, okay, of 4,70,000. Now we have identified that, okay, the carrying value is 4,55,000. Okay. Now it is held for sale. At 1st April 2013, the plant had a fair value at 4,70,000. We have identified the carrying value to be 4,55,000. Correct. That is 4,90,000 minus the depreciation of 35,000. Right. Now, on the date when it was classified as held for sale, the fair value was 4,70,000, which had fallen to 4,65,000 at 30th September 2013. Right? And that means at the year end, the fair value had fallen to 4,65,000. Okay. Now, firstly, guys, when it is classified as held for sale, we take the lower of 4,70,000 and 4,55,000. Correct? So that is obviously 4,55,000. So we will recognize the asset at 4,55,000, but that is on 1st April 2013 when it is classified as held for sale. Okay. By the year end, the fair value has dropped. Okay. And the fair value which had fallen to 4,65,000 at 30th September 2013. Now the fair value has dropped. Still, the carrying value of my asset is 4,55,000 only. So my value will be at 4,55,000 only. If in case my fair value drops lower than 4,55,000, then I will take that lower amount. Otherwise, till then I'll have to just take the lower of carrying value and the fair value, which is obviously here the carrying value 4,50,000. So I'll select that. Okay. I hope it is clear, guys. Okay, moving on to the next question. Which of the following items should be classed as an asset for sale under IFRS 5 non-current assets held for sale and discontinued operations? Macon Company's head office building is to be demolished, at which point the land will be put up for sale. A number of prospective builders have declared an interest and the land is expected to sell within a few months of its demolition. So technically this is just a scrap sale. This is not like an asset is genuinely held for sale. Okay, because it is going to be demolished, right? So technically this might not be considered as held for sale. Okay. So you have to class the asset which is to be considered as held for sale. Second one, an item of plant was put up for sale at the start of the year at $5 lakh, right? Six parties have made a bid to make on company for the plant, but none of these bids have been above $2 lakh. This will not be classified as held for sale because you are not actually bidding it at an appropriate value. If six people are bidding it and none of them are bidding it over $2 lakh, that means your asset would not be worth more than $2 lakh. Correct? But still you are classifying it as held for sale at $5 lakh, which is inappropriate. It should be classified at fair value terms. So here B will also be not the answer. A chain of retail outlets are currently advertised for sale. Macon Company has provisionally accepted a bid subject to surveys being completed. The surveys are not expected to highlight any problems. The outlets are currently empty. That means technically this would be an appropriate response, right? Because the outlets are empty, that means they are held for sale, you can say, because the company is not making use of it, right? Secondly, they are advertised for sale. Thirdly, if they have accepted the bidding, that means they are advertised at correct fair value terms. So yes, I can say C is going to be the correct option. The fourth one is a brand name which Macon Company purchased in 2012 is associated with the sale of potentially harmful products. Okay. Macon Company has decided to stop producing products under this brand which is currently held within intangible assets. If you're discontinuing it, it will be considered as a discontinued operation, not technically as held for sale. Okay. You're just completely discontinuing it, not considering it as held for sale. So technically C is going to be an appropriate response to this question. I hope it is clear to you all. Moving on to the next question, guys. Now we jump to the third part, that is where we'll understand the third section B question. Before that, again, we'll take a 10-minute break. After that, we'll return with the third part. Okay, guys, I hope we are back from the break. Shall we start? Okay, so now this is the last scenario for your section B. With this, we'll be done with section B, 7 questions and a full-fledged mock paper. And after this last question, we'll end the session for here. Okay, I hope you've actually understood all the section B questions here, guys. If you have any doubts regarding them, you can just directly text me on YouTube, right? Now, let us firstly look at what they are asking for. In accordance with IS 32, financial instruments presentation, which of the following describes an equity instrument? So, what is an equity instrument, guys? A contractual obligation to deliver cash or another financial asset to another entity. Obviously, if I have to pay, if I have to deliver cash to another entity, it is a financial liability to me, correct? If I have an obligation to do so. Second one, so this is not an equity instrument, correct? Second one is a contract which is evidence of a residual interest in assets of an entity after deducting all of its liabilities. Yes, this could be considered, right? Because a contract wherein the evidence is of a residual interest, that means the remaining interest after deducting all the liabilities from the assets. That is nothing but the equity instrument of a company, correct? That is nothing but the equity instrument of a company, right? The third one, so technically this should be the answer, I feel. The third one is a contract right to exchange financial instrument to another entity under potentially favorable conditions. This is a financial asset, guys. Okay, if in case I exchange my option, so I'm giving up my financial asset, that is option, and in return I'm getting financial asset, probably shares, right? So that will be considered as a financial asset. And the fourth one, a contract which gives rise to both a financial asset of one entity and a financial liability of another. That is a simple definition of financial instrument. Okay. I hope you all have understood the third point, how it is a financial asset. I'll explain you if in case any part is misunderstood. So guys, what is an option? Maybe say I want to purchase another company's shares. Okay. And for purchasing another company's shares, maybe say I don't want to purchase it right now. I want to purchase it on a later date. Okay. I want to purchase it on a later date. And, because probably I do not have cash right now. And the market value of that company's shares is maybe say $3 right now. Okay, I want to purchase it on a later date, maybe after 6 months. Now I am thinking if I purchase it today, it will cost me $3 per share. Maybe I want to purchase 100 shares. Okay, I want to purchase 100 shares. It will cost me $3 today. So it is okay. I can pay this price, but I do not have the cash today, right? And I want to purchase it after 6 months. But I'm feeling that after 6 months the market value of these shares might rise up to $5. Okay, so if in case I'm feeling that later on the market value of these shares, if they rise up to $5, I'll have to pay more, correct? I'll have to pay more. So in such a case, what I'm doing today, I'm purchasing an option. Okay, today I'm purchasing an option which gives me a right to purchase the shares of the 100 shares after 6 months, and that is at $3 only, right? So today I have an option with me to purchase the shares on a later date at $3 only. Okay, so this option is technically an asset to me, correct? This option is technically an asset to me because it will give me future economic benefits, right? Why? How will it give me future economic benefits? Because obviously, on a later date, when I go to purchase these shares, the market value of these shares will probably rise up to $5. But since I have an option today, I will purchase them at a cheaper price, that is $3. Correct? So that means because of this option, I am actually going to get a benefit. So technically, this option is a financial asset to me, right? So when I on after 6 months, when I will purchase these shares, I will give up on I'm so sorry guys. I will give up on my option. That means I'll give up on my financial asset. right? I mean, I will exercise my option, and in return, I will get shares, right? And this transaction will happen under conditions which are potentially favorable to me, correct? Because I'm exercising my option, that means my option will be gone, and in return, I am getting shares and under conditions which are favorable for me. Because obviously, in the market, if I go and buy, each share is costing $5. But since I have an option, I can purchase those shares at a cheaper price, that is $3. So, this is an exchange of financial instruments. I'm giving up one financial asset and taking a financial asset in return, that is the shares of the other company. So these are the exchange of financial instruments under the conditions which are potentially favorable, and thus this option today is will be known as a financial asset, right? So since it will be known as a financial asset, they are asking us what is a equity instrument. So option C is not going to be the right answer. So I hope it is clear, guys. Option B is going to be the correct response here. Moving on to the next question. Okay. In accordance with IAS 32, how should the issue of convertible loan notes be recognized in withdrawn company's financial statements? Now, what are convertible instruments, guys? Convertible instruments are nothing but any convertible preference shares or convertible bonds or anything. So, what is convertible in it is that maybe say I've issued convertible bonds. Okay. So, if I've issued bonds out in the market, I will have to, whoever purchases those bonds, it is my obligation to pay them to pay them annually the interest and also the capital repayment on the redemption. Okay. Maybe say I've given them a bond for 5 years. Okay, they've purchased those bonds, so I will pay them interest for 5 years, and after the 5 year period, I will repay the amount whatever they have given to me. Right now, in convertible instruments, what happens is I am providing them a bond. Okay, so that means I'll have to pay them annually the interest and also the capital repayment. But with that, I'm also giving them an option that if they don't want the capital repayment or something, they can convert those bonds into equity shares of the company. So that means I'm giving them an option to also convert those bonds into equity shares. Now that can be converted at any time, at the first year end, second year end, third, fourth, fifth year end, any time. Okay, but upon different conditions. If you convert it at the first year end, you will get more shares. If you convert it on the second year end, you will get less shares comparatively, and that shares keep on reducing. Okay, why? Because firstly, company has a lot of debt. Okay, the company does not want to show debt. So if you convert those into equity shares as soon as possible, that much of the company's debt will be reduced. Correct? Because bonds are a debt to the company. Correct? And secondly, these shares that are there, I will keep on reducing because if in case the customer has converted the bonds into shares by the first year, they've just enjoyed 1 year of interest, correct? 1 year of interest. I will have to pay just the interest for the first year. Okay. So I will say, okay, you can take 100 shares for the $100 of bond. If they convert it at the second year end, I have paid them interest for two years for the first year and the second year. So I will say that you have enjoyed the interest for 2 years. So I will pay you less shares now. For the third year, you have enjoyed 3 years of interest. So I will pay you even more less shares now. Right? So those are convertible instruments. I hope the concept is clear to you all. Now we'll check that what is the question. Right? So technically guys, in convertible instruments, the holder gets an option to actually enjoy it till the redemption date. So for me, it could be a liability, a financial liability. Also, on the other hand, it is going to be my equity. Correct? That is how we do the split accounting. Okay. So here we are going to do the split accounting because see here I have a liability to pay the interest, to pay the capital repayment, and also there could be a possibility that the holder actually converts these bonds into equity shares. So I might have to issue shares also. Okay. So here I have a liability as well as an equity. So whatever is the total proceeds, net proceeds, that I receive on issuing these convertible bonds. Okay. Maybe, I issued the bonds and for that I received, whoever purchased the bonds, they will pay me right now. Correct. So the total net proceeds that I'm receiving maybe says 20,000. From that, whatever is the present value of the financial liability, of the complete present value of the complete financial liability, that will be deducted and the remainder of the amount will be the equity. Correct. Because this is with me right now. From this, whatever is the liability is reduced, the residual value is my equity. Correct. Now, the question is asking me that in accordance with IS 32, how should the issue of the convertible loan notes be recognized in withdrawn company's financial statements? As debt, interest should be charged 6% because it cannot be assumed that loan note holders will choose the equity option. This is incorrect, right? Because you have to recognize both of them, right? Equity also and your liability also. As equity, because loan notes are convertible into equity shares, but it should be recognized as liability also. As debt and equity, because the convertible loan notes contains element of both. Yes, so this will be correct. As debt, interest should be paid 9%. Okay, this should be correct because it is a convertible loan note. So on this, it will be the split accounting. That means I'll have to recognize a debt also, a financial liability also, as well as an equity component. Okay. So I hope this question is clear to you all. Moving on to the next question. Okay. What amount in respect of the loan notes will be shown in the non-current liabilities in withdrawn company's statement of financial position as at 1st April 2012? Okay. That means at the start of the year, what is going to be the value of my non-current liability? Now let us look at the scenario because now we have to deal with the calculation part. Okay. Withdrawn company issued $2 million of 6% convertible loan notes on 1st April 2012. Okay. The convertible loan notes are redeemable on 31st March 2015. That means 2013, 14 and 15. That means after 3 years, it is going to be redeemed. Okay. And it is going to be redeemed at par for cash or could be exchanged into equity shares of withdrawn company on that date. Similar loan notes without a conversion option carry an interest rate of 9%. Firstly, guys, for calculating the present value relating to my financial liability, I will take into consideration the cash flows. Right? So every year I am going to pay 6% interest. Right? So at the first year end, it is a 3-year period, correct? First year end, second year end, and third year end. What are my cash flows? 2 million is the total value. I'll pay 6% interest on it. So 2 million into 6%, that is 120 in the first year, 120 in the second year, and assuming that this is only a financial liability, Okay, assuming that this is only a financial liability, I will calculate only the financial liability component. Okay, that means this does not have a convertible option. That is what I'll assume. Okay, for calculating the financial liability part. Okay, so in the last year, if it is redeemed, it is redeemed at par. That means $2 million that I received today, the $2 million that I'll have to repay at the third year end. So $2 million I'll have to repay, $2,000 I'll have to repay at the third year end, plus 120 interest also I'll pay at the third year end. So technically at the third year end, in total I will pay 2120. Right? Total value that I've received today is 2000. That is 2 million, correct? Because I issued them at par, I've received 2000 today. Now, what are the total cash flows? 120, 120 and 2120. These are all the amounts that I'm supposed to pay related to the financial liability component. Okay. These are future values, right? Because I have to calculate its today's value. These are going to be incurred in the first, second and third year end, right? So these are future values. I'll have to calculate their present value. And for that, I have been given an effective interest rate, right? So the effective interest rate is 9%. And that is taken as because for a similar loan note out in the market, which is not a convertible instrument, okay, it is just a simple loan note, it is a simple debt to me. For that, the effective interest rate is 9%. And since I'm assuming that this component is completely a financial liability, It is completely a financial liability. So I will just simply take the 9% on which there is only a liability component. So 0.917, 0.842 and 0.772. 0.917, 0.842, 0.772. Okay, I'll multiply this with the cash flows and I will get the present value. So 120 into 0.917, that is 110.04 plus 120.842, that is 101.04 plus 2120 into 0.772, that is going to be 1636.64. Okay, I'm not able to write it. 1636.64. Okay, 0.64. So the total value will be 110.04 plus 1636.64 plus 101.04. Right? Ignore this part. Plus 110.04 plus 101.0. So the total liability value, guys, total liability value, that is the addition of this value, and this value is going to be nothing but, wait, I'll just state it. The total liability value that I have got is 1847.72. Okay, 1847.72, and they've asked me to calculate the non-current liability present value, right? At the start of the year, it is nothing but the balancing figure at the start of the year, which is 1847.72, which is very close to 1848. So we will choose this as the appropriate answer. Okay. I hope it is clear to you guys. We'll move forward with the next question. Okay. In accordance with IFRS 9 financial instruments, at what amount will the Goziho, okay, very weird name, company shares be shown under investments in equity instruments in withdrawn company statement of financial position at the year end? Okay. So technically, they are asking for this, I guess. Yes, that how the equity shares will be shown. On 1st April 2013, withdrawn company purchased, no, it will be, yeah, it is equity shares only. On 1st April 2013, withdrawn company purchased $50,001 equity shares in Gohizo company at $4 per share. Okay. Now, incurring transaction costs of $4,000. That means, firstly, it is your financial asset because you are purchasing another company's equity shares, right? So it is your financial asset. You have purchased $50,001 equity shares of Goziho company, okay, in Goziho company at $4 per share, right? So technically, how much you've paid? 50,000 shares into $4 per share. That means you have paid 2 lakh. Okay, it's not available here. I'll erase this and write again. 2 lakh is the total value, correct? 2 lakh is the total value, but your financial asset is initially recognized at 2 lakh plus the transaction cost if they are not held for trading. Now let us see if they are held for trading or not. The intention is to hold the shares for trading. So if in case the intention is to hold the shares for trading, this $4,000, which is the transaction cost, they will be directly expensed to P&L. Okay, they will directly be expensed to P&L because you're just earning profit and you're doing it for the short-term trading purposes. Okay, by 31st March 2004. So this is only going to be the value of your asset. Okay, of your financial asset. Now by the year end, the shares are trading at $7 per share. Okay, that means by the year end, the value got changed, right? In addition to the gain on the investment, withdrawn company also received a dividend during the year end of 31st March 2014. Now, what is the dividend, guys? It is not clarified here. Have they clarified it somewhere? Okay, let us see. Firstly, at the start of the year, our value of the equity investment is $2 lakh. Our financial asset is $2 lakh. At the year end, it got changed to $7. That means at the year end, it is 50,000 shares into $7 per share. That will be 3,50,000. Correct? At the year end, our value got changed to $3,50,000. In addition to the gain on investment, so that means 1,50,000 is the gain on investment, correct? From 2 lakh, it increased to $1,50,000. Withdrawn company also received a dividend from Gohizo company during the year ended 31st March 2030. Right? That is all for the scenario. They have not provided us the amount of the dividend which is paid. Correct? They have not provided us the amount of dividend which is paid. So technically we'll ignore it as of now. Now, in accordance, okay, any which ways it is held for trading, guys, correct? So dividend will not be considered here. In accordance with IFRS 9, that means dividend will not be capitalized to the value of the asset. IFRS 9 financial instruments, at what amount will Gohizo company shares be shown under equity under investments in equity instruments in withdrawn company's statement of financial position as at 31st March 2004. So obviously it will be shown at $3,50,000. Okay. I hope the sum is clear to you all because at the year end it was valued to $3,50,000. If I think it may be doubtful, maybe we'll look at the solution again if in case the answer goes wrong. Okay. Even if the answer goes right, well and good, we will look at it once. Okay. Moving on to the next question. Okay. So this is the last question that we are doing for the whole mock paper. Okay. Now we'll just read through it. Hopefully we get full marks for section A and section B. Right. Now, where should the gain on investment in Gohizo company and its dividend be recognized in withdrawn company's financial statements for the year ended 31st March 2013? So the gain on investment will be shown in P&L and the dividend that they have received on the equity investments, that will be added to the equity investments, correct? In the statement of changes in equity, right? So gain on investment, no, it will not be shown in other comprehensive income. Gain on investment in profit or loss and dividend in other comprehensive income, no. Both in other comprehensive income, no. Both will be stated within their P&L. Dividend income, that is their investment income, and also the gain on investment since the shares are held at fair value through P&L because they are held for short-term trading, correct? So any shares which are held for short-term trading are taken to P&L and both will be held in your P&L, the gain as well as the dividend income that you've got, okay? Not deducted from the dividend, right? Or not deducted from the equity. Technically, both will be taken as an income to your P&L, okay? So I hope this part is clear, guys, and we'll move to the next part and end the examination here because from here section C questions are dealt with. Section C questions, if you want to get reference to them, you can go through the previous YouTube revision sessions to understand that because various section C questions are already dealt with in that classes. Okay. In those classes, yeah, now we are done with the paper. I hope it is clear to you all. On the left hand side, once you're done with it, you can have an option to end the examination. So you will click on yes. And are you sure you want to end the examination? They will ask you twice and you can now exit the paper. Okay. Now you can go on mark. Once you go on mark, guys, you can check your answers and you can also check the answers that they have provided, that where you've gone wrong and why you've gone wrong. Okay. So we have done the paper just now, FR practice exam 2 on November 12th. This is the one. We'll do the self marking. Okay. So we have scored 58 marks out of 100. That means there is just one question where we got it wrong. Let us check what is that question. Okay. First question is right. Second question is right. Third is also right. Fourth is also right. Fifth is also right. I hope you all are proud of yourself. We have already scored 58. We've cleared the examination. Which question is wrong? Not able to identify the one. Probably it must be one of the last two questions. Okay, it is this one. Last two questions are both correct. It is this one. So let us see this again. What is the question and where we have gone wrong? Okay. What is the total amount charged to Macon's profit or loss in respect of the property for the year ended 30th September 2030? Right? So property, the amount was to be charged was 1,50,000, but we calculated it to be 1,80,000. Let us check why. Okay. Where is that property one? I think this one. On 30th September 2013, Macon Company moved out of one of its property and put it up for sale. Okay. At the year end, they put it up for sale. What is the question again? What is the amount of charge that is to be made, right? Total amount charged to P&L in respect of property. Yes. So it could include the impairment also, right? On 30th September 2013, Macon Company, okay, I'm not able to mark this. Yeah. Macon Company moved out of one of its property and put it up for sale at the year end. The property met the criteria as held for sale at 30th September at the year end. On 1st October 2012, that means at the start of the year, the property had a carrying amount. Oops. The property, okay, I think the battery is going off. No, it can be done only till here. Okay. The property had a carrying amount of $2.6 million and the remaining useful life was 20 years. Okay. So that means 2,600 was the value of the property and its useful life was 20 years. So the depreciation will be charged. It will be charged from 1st October till the year end 30th September 2030. Okay. The property is held under the revaluation model. The property was expected to sell for a gross amount of $2.5 million with the selling cost estimated to be $50,000. Okay. So the property was held under the revaluation model, guys. Now, firstly, we'll depreciate. What is the depreciation? The depreciation, guys, is 2,600 divided by 20 years. That is going to be 130. Right? That is going to be 130. Then, at the year end, the fair value, it will be classified at IFRS 5. It will be classified under IFRS 5 and under IFRS 5 it is taken at lower of fair value and fair value less cost to sell and carrying value. Correct? So what is the fair value less cost to sell? The fair value less cost to sell is nothing but, you can see the fair value is, okay, we identified the depreciation amount. The carrying value will calculate. Carrying value will simply be, guys, 2,600 minus 130, that is 2,470, right? The fair value is 2,500 and the selling costs are 50,000, right? The fair value is 2,500 and the selling costs are 50,000, right? So 2,500 minus this 50, it will be 2,450, correct? The fair value with less cost to sell is 2,450. So I should take the lower of these two, that is 2,470 or 2,450. That will be 2,450, right? So technically, the value that will be there will be this, correct? And our carrying value is 2,470. That means we have to bring it down to 2,450, right? We have to bring it down to 2,450. So that means we will charge impairment of 20,000. I think we've done it correct, right? We have to charge impairment of, okay, I just did not add it correctly. Yes, impairment of 20,000 and obviously the depreciation that has been charged to date is 130. So the total value will be depreciation charge to the P&L 130 and 20,000 as the impairment. So total will be 1,50,000. I think by mistake I would have chosen 1,80,000. It was a silly mistake, guys. Otherwise we are completely correct with the whole paper. If you have any doubts regarding the silly mistake that I've made, Please ask me any doubts regarding it, and please don't make any such silly mistakes in your examination. Okay, rest I think everything is correct because we've scored 58. That means only one question was wrong. Yes, everything is perfectly done. For your 31 and 32, you can see you are going to prepare the consolidated goodwill and the P&L here they've asked for. This is the scenario. You can go through the scenario. And on the right hand side, guys, on the right hand side, you have an option to actually click here. Once you click there, you have an option to look through the solution also. So they will give you the solution on the left hand side. I'll just hide this question stem. I think it is lagging a bit. Okay, it is stuck. Yes. So you can see guys, it is stuck right now, I feel. Right? You can see here they have also provided you the whole calculation that how the solution is to be done. You can just right click and save the image. Okay. So you can save the image, you can save the PDF and then solve the sum for yourself. If any doubts, you can just clarify it by yourself through the solving. Okay. So they've provided you with everything on the portal itself. I hope it is clear to you all, and anything doubtful can be directly asked for in the comment section. I think it is lagging a lot now, guys. Yeah, anything can be directly considered within the comment section. You can ask for it and we can deal with it. Okay. So with this, guys, we are done with our mock paper also and our revision session. Please practice well. Our intention was to conclude section B this time. So I hope we have concluded section B well. And I hope each of the questions were perfectly understood to everyone. If in case you will find any difficulties, you can let me know. I can actually show you the chapters, main parts that you're supposed to understand. Okay. And also for section C, if you want to go get any reference for it, you can go through the previous sessions also and you can understand the theory and the chapters through the previous sessions, right? That means your consolidation can be understood from the previous YouTube revision sessions, which is obviously provided to you for free. Now again, we will meet in the next quarter with our same FR with different chapters to cover. Okay. So all the best, guys. Thank you so much for your time and efforts. We meet in the next quarter with the new YouTube revision sessions. Okay.